So as you know, our little group brings together economists and lawyers. So I'm going to say a little bit about our thinking on some of the economic aspects of the residual profit allocation scheme. I'll be fairly brief because part of the message is, more generally, as Paul said, in many respects we're not, I think, yet ready for prime time, but let me take you through some of our thinking at the moment. So basically with any scheme, we want to be able to say something clear and coherent about how it matches to a number of the principles that we mentioned in the previous session. So what kind of distortions, if any, might it imply? What kind of vulnerability to tax competition does it show? More generally, if governments were to set tax rates kind of non-cooperatively under the scheme, what would the outcome look like? We'd like to know about incentives for countries to kind of adopt this approach. And something that we also, the theme that kind of percolates through a lot with the work we've been doing in the group, so I think we still want to focus on it rather more explicitly, is what is the impact in particular on developing countries. So let me say a little bit about that. And as I say, I'll be fairly brief. I always have to say none of this can be attributed, none of this lack of knowledge can be attributed to the IMF. Everything, the lack of knowledge I display is completely my own and should not be attributed to any of my bosses. One message, I think, is that this is actually analytically quite a challenge to think about for two reasons. One, you give an economist a tax scheme, the first thing they want to do is write it out and then do some kind of comparative statics and figure out what it does for incentives, for firms, and for governments. A couple of issues here. Of course, this is quite analytically, it's quite a novel proposal. We have pretty good models, I think, to help us think about destination-based cash flow tax, straightforward form of apportionment. This is a more sophisticated scheme to think about. And analytically, it has challenges because we have a number of parameters within the tax system. We have the markup rates, we have the rates of tax on routine profits, and we have the rates of tax on residual profits. Those tax rates could be different as well as being different across countries. So instead of having like one tax rate, we have a number of things to think about. So that is complex. When I say complex, I mean in an analytical sense. I'm not implying anything about complexity in terms of implementation relative to the current system, where of course we think actually it has a number of quite significant advantages. So given all that, what can we actually say? What are the kind of issues that we need to address in thinking about this proposal? Well, one thing we can say is kind of reassuring is that it's a coherent approach in the sense that we're parceling things up into routine and residual profit, and we have a coherent way of doing that in the sense that adding up these tax bases adds up to the aggregate profits of the multinationals, which is a kind of minimal test we might want for coherence. So it's well specified in that sense. One issue, though, that Paul also touched on is that it's not necessarily the case that the sign of total tax payments is the same as the sign of total profits. That is, you could have a multinational that on aggregate makes a loss, but is still paying positive tax. Conversely, that it's paying positive tax, but has a loss. And there's some discussion in the paper about how one might deal with that. Intuitively, that's because, we're taking the aggregate profits and we're dividing it into various bits, the routine bits, the residual bit, which we're taxing potentially at arbitrary and different rates, which is one difference from a straightforward form of apportionment. So that's something, as Paul says, we have to figure out how to handle these various possibilities that arise, which are not necessarily incoherent. There may be perfectly good reasons why that's a sensible outcome, but they're clearly things we'd have to think about what the practical implications would be. So what can we say about some of these neutrality issues in terms of how this scheme would affect companies' decisions? Well, one thing you might want to look at is, how does it affect companies' incentives in buying inputs from third parties at different locations? What does it do to the price of your inputs? Well, this gives you a flavor, I think, of the kind of things one has to think through. Suppose I buy a little bit more of some non-labor input from a third party somewhere in this multinational. What are the tax consequences of that? Well, there are basically two. One is that will go into the calculation of my routine profit in the jurisdiction where I make the purchase. So there's a routine profit, and the routine profit element, and that will give me a positive tax charge. But remember too that when we calculate residual profit, we're going to get a deduction for costs that are kind of common across the group, or for costs that can be allocated to a particular jurisdiction where we're taxing residual profit. So that's a deduction against residual profit. So actually that purchase reduces that component of tax that we pay. It reduces the residual profit component. So we have a positive bit from the routine profit and a kind of negative bit from the residual profit. And you can intuitively see how that works out is going to depend on what the markup is, what the markups are, what the routine profit tax rate is, what the residual profit tax rate is. So we have to, what the applicable residual profit tax rates are. So we have to think through how all that works out and which way the incentives go. Of course, these incentives may not be that big in practice. That'd be the second stage, where to say, well, if there is some distortion, does it really matter very much? Possibly not. But one thing we have to do, I think, is think through a little bit more what these distortions might mean. Another set of issues then come up that one then has to address is this issue of, well, what happens in terms of strategic tax incentives? That is, if a government, if we've implemented this scheme, and we have a number of countries participating, what are the rates, what are the kind of, and countries look, say, they've commonly agreed the scheme, but they have some discretion over the tax rates they apply. Will those tax rates be in some sense too high from a global perspective? Will they be too low from a global perspective? And it probably won't be a surprise, given the kind of things I was just saying, that there are really quite a number of different effects going on that one has to think about. And really the question here boils down to, if I, as one country, change my tax rates, residual or routine, how does that affect you, the other countries? Basically, if when I increase my tax rate, that's good for you, that will tend to mean I set my tax rates too low when I look at my own national interest, because I don't, presumably, pay attention to the benefit that you derive. Conversely, if when I raise my tax rate that harms you, probably I'm going to end up setting tax rates too high from the kind of collective global perspective. So a number of things we have to think through there. For example, if I increase, what happens if I, as country A, increase my residual profit tax rate? Well, what that means is, again, we have these deductions going on, so that reduces the cost of some of the inputs that are getting deductions against my residual profit tax. That presumably means that there will be more of those inputs purchased, which means that other jurisdictions, me too, but also other jurisdictions will now have higher revenue from their routine profit, because that will go into the increased input purchases will go into the calculation of the routine profit component. Their revenue will go up. So that means that component alone, and I'm just picking up one of several effects, that means that I will probably tend to set my tax rate too low because I ignore a benefit that I confer on you in setting my residual profit rate tax, in increasing my residual profit tax rate. I won't go into this, but on the other hand, you can make an argument that there are some effects when I increase my routine profit tax rate that may actually be harmful to you. Maybe that sales in your jurisdiction go down, so you get less revenue from your residual profit component, and that would suggest I will tend to set my my routine profit tax rate rather too high. So again, this is a lot to kind of to grasp, but I think I would just want to convey that there are a number of things we have to think about here. A number of these effects may actually be beneficial in terms of the appeal of the scheme. We did earlier work through a version of Reuven's scheme, which is slightly different, which did, I think, have some quite nice properties in terms of this strategic tax setting, but we have more to do on this scheme, which, as Paul explained, is somewhat different. The final point, just to touch on, again, just really to note that we haven't thought as much as we planned to about it, is the impact of this scheme and also destination-based cash flow on developing countries. As Paul mentioned, we certainly kind of set aside, in a way, resource-based taxes, maybe taxes on things like telecoms too, where we clearly think that's something that should remain subject to particular rent taxes or auctions or something in lower-income countries. Beyond that, of course, we'd have to think, well, if we think about a scheme like this, many developing countries presumably will end up more or less with the routine profit component. We'd have to say, is that really that different from what they get at the moment on the non-resource side of things? We could even talk about, well, if we are concerned with revenue developing countries, maybe we need to think about what the appropriate markup is to apply in lower income countries, which is not dissimilar to something Michael Durst has thought about. But I'll leave it there, I think, just to give a sense of that we are still working on. One of the reasons we want to get feedback is because we want to think more about what the important economic questions are. There are some things we can say in terms of understanding the scheme. There's clearly more to do, which clearly I think very much ties in with the practical issues that, as Paul mentioned, we still need to think through. But I think we can see some actually quite encouraging signs in many respects about the scheme, which is something we will be planning to amplify and explore more as we go on. So I'll finish there. Thank you.